Welcome to The Deep Dive, the show dedicated to cutting through the noise of earnings calls and bringing you the most critical insights. Today, we're unzipping the latest from Build-A-Bear Workshop. They just reported their second quarter 2025 results. You've given us a stack of materials covering everything from their financials to their strategic vision. And our mission really is to extract those key nuggets so you can be truly well-informed on Build-A-Bear's trajectory.
And what a quarter it was. It certainly caught the market's attention, showed some really impressive momentum, goes well beyond just hitting the targets. We're going to break down what truly drove these standout results and maybe more importantly, what management is signaling for their future growth path.
Absolutely. We're talking about a company that's been on, quite a journey of transformation. And these latest numbers give us a really clear picture of their progress. So, okay, let's dive right into the headline figures from Build-A-Bear's Q2 2025. That wrapped up August 28th. What were the standout numbers that tell us this wasn't just, a good quarter, but actually pretty remarkable?
Yeah, remarkable is the right word. It was a historic period for them. The company delivered its best second quarter and first half results in its entire history. To put some numbers to that, earnings per share came in at an outstanding $1.94. That's a significant beat against the analyst consensus, and it represents a substantial 46.9% increase year over year.
Wow. Okay. And it wasn't just the bottom line surprising everyone, right? We saw total revenues soar to $124.2 million. That's an 11.1% increase year over year. So they didn't just meet expectations, they handily surpassed them. Signals robust demand, effective execution.
Right. And beyond that top line growth, profitability really shone through. We saw excellent gross margin expansion, up 340 basis points. That's 3.4 percentage points to 57.6%. It's a strong indicator of their pricing power and efficient operations. Pre-tax income jumped a remarkable 32.7% to $15.3 million. And to underscore their agility, the digital side, the e-commerce business, showed impressive growth too. E-commerce demand up 15.1% year over year.
Those are not just good numbers. They signal a company that isn't just surviving, it's really thriving and evolving. And the market reaction reflected that, right? Validated management's clear optimism. But these kinds of results don't just happen by accident. So what are the strategic underpinnings? What's really driving this stellar performance? Sharon John, the CEO, she highlighted a long-term focus monetizing their unique market position through 3 strategic pillars.
Precisely. And understanding these pillars is, I think, key to grasping the why behind the success. The first one is all about the expansion and evolution of their experiential retail footprint. What's fascinating here isn't just that they're opening new locations, but how and where they're doing it. This quarter alone, 14 net new global experience locations opened. And what's really striking is that a significant chunk, 86% of those, were international.
That international push is where it gets really interesting, isn't it? I mean, we're seeing them enter entirely new countries like Georgia, Uzbekistan, expanding in places like Colombia, Mexico, Australia. And they're even coming back to Germany in Q3 through an existing partner in our stores. Domestically, too, the partner strategy seems to be paying off. Girl Scouts now at 33 locations, and Great Wolf Lodge expanding to all 22 U.S. lodges. This feels like more than just growth. It's like a strategic land grab.
It absolutely is.
Yeah.
And the genius behind it, I think, lies in their capital-light, partner-operated retail model. This isn't just some fancy term. It's a fundamental shift in how they scale. It minimizes their direct capital expenditure risk, right? Allows them to maximize global reach without tying up significant corporate funds. They now boast 157 partner-operated units. That makes up a substantial 25% of their total locations. And this model, for instance, is how they're planning that big multi-level workshop at Icon Park in Orlando, scheduled for H2 2026. They can do that without taking on all the direct financial burden. It's a smart playbook for sustained expansion.
Okay. So the second pillar then is the advancement of their comprehensive digital transformation. And like you said, this isn't just about putting products on an e-commerce site. It's about fostering deep, continuous engagement. How is this strategy playing out in practice?
Yeah, you hit on a crucial point. Engagement. They're really ramping up social media initiatives across platforms like Instagram and TikTok, understanding where their customers, current and potential, spend time. They're leveraging user-generated content, which is, incredibly powerful, and using it to engage a broader consumer base, including that kidult demographic. These are adults who grew up with Build-A-Bear, maybe rediscovering it or engaging as collectors. Their fruit stand assortment marketing campaign, for example, drove triple-digit growth in media impressions in Q2. Shows the effectiveness.
Right. And the web business plays a critical, almost unsung role in this whole omnichannel approach. Beyond just direct sales, their find a store, plan a visit, plan a party pages, those are actually their most visited web pages, which indicates the website's crucial function as an information and planning tool, actively driving traffic into the physical stores. It's a full circle strategy.
Indeed. It beautifully illustrates how their digital efforts aren't siloed. They're deeply integrated to enhance the entire customer journey. And that brings us neatly to the third pillar, investing in opportunities to leverage their powerful brand equity beyond traditional retail. This is where they're really thinking outside the traditional box.
This is where Minibeans comes in, right? That collection really shines as an example here. Launched just last year, February 2024, this collectible line saw an incredible 80% year-on-year revenue increase in Q2, just massive growth.
Huge.
And they're also strategically pushing Minibeans into wholesale channels now, Hudson Airport locations, Apple Green convenience stores, international toy partners. And we even heard about an upcoming licensed Minibeans Sanrio launch. I imagine that will be huge.
Yeah, that could be very big. And what's truly fascinating here is how effectively they're transitioning from what many might have seen as just a single channel, nostalgia-driven brand, to a dynamic, omni-channel global entity. Products like Minibeans are instrumental in this, allows them to diversify revenue streams, tap into the lucrative world of collectible economics, and reach consumers in places they never could before with just the traditional workshop model. It's really a testament to their brand's enduring power and, frankly, its adaptability.
It's clear these strategic shifts are profoundly reshaping the company. But how does this translate to the financials? That impressive 340 basis point gross margin improvement, for instance, that wasn't just luck, was it?
No, absolutely not. It's a direct outcome of meticulous operational discipline. It reflects improved merchandise margins, a strategic reduction in promotional activity, and yes, selective price increases. What's clever here is their nuanced approach to pricing. They are strategically raising prices on collector-focused stuff, licensed products, knowing that demographic is generally less price sensitive. But at the same time, they're protecting those crucial entry-level price points. Programs like Count Your Candles, where kids pay their age for a product during their birthday month. That ensures accessibility, keeps the core magic alive,
That's a fascinating balance, but doesn't raising prices even selectively risk alienating some customers? Or impacting foot traffic? What's the impact on the consumer experience?
That's a very valid question. And the data, interestingly, suggests they've navigated this just about perfectly. They haven't seen a negative impact on traffic. In fact, domestic store traffic actually rose 3%, while the national retail benchmark saw a 3% decline in the same period. So relative outperformance there. Their conversion numbers were slightly up as well. This indicates their value proposition remains strong, their strategic pricing isn't deterring customers, it's optimizing profitability. And beyond that, they're committed to returning capital to shareholders. Returned $13.1 million already in the first half of fiscal 2025. And they still have about $80 million remaining under their share repurchase authorization.
Okay, so with such robust performance behind them, the natural question is, what about the rest of the year? How has this stellar performance recalibrated their full-year guidance for fiscal 2025?
Yeah, they've certainly raised the bar. They've updated their revenue growth expectation now to mid to high single digits. That's a clear upgrade from their previous mid-single-digit guidance. Pre-tax income is now anticipated to be between $62 million and $70 million. That assumes current tariff rates hold, of course. And their net new unit growth guidance, that's also been raised from at least 50 to now at least 60 new experience locations, reflects their confidence in the expansion.
Right. But even a company firing on all cylinders has to deal with broader macroeconomic headwinds. How are they navigating challenges like tariffs, rising operational costs? Those are real concerns.
They are, and this raises an important point about their agility. Tariffs, as we know, are a real cost, impacting their North American business specifically. Management was smart here. They strategically pulled forward inventory last year. That effectively limited their Q2 tariff exposure to only about $1 million.
Okay.
For the full year, the net impact of tariffs is expected to be less than $11 million, and that's after mitigation efforts like dual sourcing from China and Vietnam. They're also factoring in roughly $5 million in additional medical and labor costs, brings the total headwinds to nearly $16 million for the year.
That's a significant figure to absorb, and they also acknowledge facing, quote, tougher comparisons for the second half, especially around Halloween. So what are they planning? Any specific operational levers or marketing pushes to navigate that pressure and keep this momentum going?
Well, despite those significant challenges, management believes they are on track to close the year at or slightly above last year's full-year profitability, which is a powerful testament to their operational discipline, really. They are acutely aware of the tougher comparisons in the second half, yeah. Especially given last year's strong performance, particularly around Halloween. Their strategy here isn't necessarily about massive new initiatives, but rather reinforcing those existing pillars we talked about. Continued capital-light expansion, leveraging their strengthened digital engagement for peak holiday traffic, and pushing those diversified revenue streams from products like Minibeans. It's really about executing on the strategy that's already proven successful and trusting in the strength of their revitalized brand to carry them through.
Okay. So pulling it all together, what stands out to you most from this deep dive into Build-A-Bear's latest earnings, connecting all these dots?
I think if we connect this to the bigger picture, Build-A-Bear is successfully evolving from, a cherished, nostalgia-driven brand into a truly dynamic, omnichannel global entity. That's the key transformation. Their capital-light partner-operated model, that's a clear differentiator. It enables rapid, low-risk international expansion that few traditional retailers can really match. And the remarkable growth in things like Minibeans, plus that robust e-commerce demand, it highlights effective product innovation and digital engagement. They're tapping into new markets like the kidult segment and fostering repeat buying behavior. It's kind of a masterclass in brand reinvention.
Yeah, it's just a remarkable degree of operational credibility and an impressive ability to execute strategically, even with those macro uncertainties swirling around. It's not just talk, it's really a proven track record of delivery now.
Exactly. So key catalysts to watch going forward. Continued pace of unit openings, especially those international partner-operated locations, further expansion of Minibeans, wholesale rollouts, the success of licensed lines like that upcoming Sanserio launch.
Right.
Also, keep an eye on their digital engagement metrics and, critically, their performance during key periods. National Teddy Bear Day, September 9th. The October launch tied to the Wicked sequel, and of course the crucial holiday season. Their multifaceted ability to monetize brand equity through retail experiences, digital channels, smart licensing that's absolutely central to its sustained upward trajectory, I think.
All right, so for those of you actively watching the market, you've heard the numbers. Fantastic beat and raise quarter, accelerating global expansion, this ingenious capital light model. Now, the market has certainly priced in a good chunk of this optimism already. So how might we get creative here looking ahead? This is where we put on our speculative hats.
Okay, speculative hats on. Given Build-A-Bear's articulated multi-year growth arc, transitioning to this dynamic omnichannel global entity, I'm thinking about maybe a two-part speculative play here. First, to capture that longer-term potential, one might consider leveraging a long position through long-dated out-of-the-money call options.
Okay, explain that a bit.
Sure. So a call option gives you the right, but not the obligation, to buy a stock at a certain price, the strike price, by a certain date. Out of the money means that strike price is currently above the stock's market price. Makes the options cheaper, but offers significant upside if the stock really takes off. The unit expansion, the Minibeans rollout, the digital stuff, these aren't short-term fixes. They're foundational shifts designed for multi-year impact. If they keep executing this vision, particularly with that partner model, unlocking truly exponential global scale that maybe isn't fully reflected in near-term multiples, well, a significant appreciation in the stock price within, say, the next 18-24 months isn't just plausible. It's a potential outcome given their profitability and cash generation. The strategy offers leverage on that long-term vision without tying up, excessive capital directly in the stock.
That's certainly thinking big and looking way out. What about something to maybe hedge against those headwinds they mentioned, or maybe a relative value play?
Right, part two. To hedge against potential seasonal choppiness or unexpected macro wobbles that could temper the narrative short to medium term, especially given their own acknowledgement of more challenging comparisons for the second half. One could consider a short position on a basket of traditional single-channel specialty toy retailers, the ones that demonstrably lack Build-A-Bear's experiential or omnichannel diversification.
Okay, so betting against the old model.
Kind of. We're talking companies heavily reliant on just traditional brick-and-mortar foot traffic, without the digital engagement, the collectible innovation, or that capital-light expansion model Build-A-Bear is showing off. The idea here is that Build-A-Bear's strategic agility and diversified revenue streams could allow it to gain market share or simply navigate headwinds more effectively than its, let's say, less evolved peers. So it pairs a high-conviction long or leveraged long via options on Build-A-Bear's execution with a relative value short, betting on the continued differentiation of their model in what is still a challenging retail landscape. It's really a bet on the evolution of experiential retail, with Build-A-Bear leading the charge.
Okay, so to summarize them, Build-A-Bear Workshop's Q2 2025 earnings call really showcase a company firing on all cylinders, delivering record financial results driven by that strategic global expansion, digital innovation, and some really disciplined execution. The strong performance led to a significant upward revision in their full-year guidance and clearly a very positive market reaction.
Yeah, Build-A-Bear is successfully evolving its business model, leveraging its iconic brand in incredibly smart ways, and really setting the stage for continued profitable growth that extends far beyond just simple nostalgia.
As always, please remember this is for informational purposes only. It does not constitute financial advice. We strongly encourage you to conduct your own thorough due diligence before making any investment decisions. And as Build-A-Bear continues this impressive evolution, maybe the provocative question for us to ponder is this: how much further can a brand so deeply rooted in childhood nostalgia push the boundaries of experiential retail before it fundamentally redefines itself beyond its original bear-building core? Could it become something entirely new? Thank you for tuning in to The Deep Dive, and we look forward to your insights and feedback.